This week was one of the most consequential weeks for the AI stocks that we have been tracking on this channel. Rather than walking through each of these stocks individually, I want to start with the macro story that drove everything. Because the individual moves only make sense once you understand the structural shift the market repriced this week. The most important development this week was not a single earnings report. It was the sudden widespread recognition that the agentic AI era is creating a second major hardware demand cycle. And that cycle runs parallel to and is now beginning to compete for attention alongside the GPU cycle we have been invested in. The catalytic moment was Thursday night's Intel earnings, but the real story was what Intel's numbers confirmed, that CPUs are now supply constrained because of AI. Intel's data center and AI unit posted $5.1 billion in revenue, a 22% year-over-year gain, well ahead of the $4.41 billion consensus. The company also noted that customer demand currently exceeds what it is able to ship. Intel management framed this explicitly as an AI story. The CPU, long dismissed as a commoditized bystander to the GPU boom, is reinserting itself as a load-bearing infrastructure. And the reason is agentic AI. That thesis was spectacularly validated the very next morning when Meta and Amazon jointly announced that Meta has signed an agreement to deploy AWS Graviton CPUs at scale, starting with tens of millions of Graviton cores. The deal reflects a shift in how AI infrastructure gets built. While GPUs remain essential for training large models, the rise of agentic AI is creating massive demand for CPU-intensive workloads, which include real-time reasoning, code generation, search, and orchestrating multi-step tasks. Amazon CEO Andy Jassy put it bluntly: agentic AI is becoming almost as big a CPU story as a GPU story. The consequence for our portfolio was immediate and broad. AMD surged over 13% on Friday on no company-specific news, purely because, as D.A. Davidson wrote in an upgrade, the CPU is reinserting itself as an indispensable foundation of the AI era. And Intel's results indicate this is already translating to very significant upside for the entire CPU complex. The read-through is direct. AMD's EPYC server processors are the primary alternative to Intel in the data center, and if server CPU demand is now accelerating beyond even the most optimistic prior estimates, AMD's EPYC server processors are the primary alternative to Intel in the data center, and if server CPU demand is now accelerating beyond even the most optimistic prior estimates, AMD is a prime beneficiary heading into its own earnings on May 5th. ARM Holdings was another clear beneficiary of the week's CPU narrative. Amazon's Graviton, which sits at the center of the Meta agentic AI deal, is an ARM architecture chip, meaning every Graviton core deployed at scale generates royalty revenue for ARM. As the agentic AI era drives hyperscalers toward custom ARM-based CPUs for orchestration workloads, ARM's position as the foundational architecture licensor makes it a quiet but structurally powerful winner in this cycle. It collects a royalty toll regardless of which chip vendor ultimately captures the design win. I am beginning to build a small position in ARM on the back of this development. I am viewing the current entry as an opportunity to establish exposure to what I believe is a structural multi-year royalty tailwind that the market has not yet fully priced into the agentic AI narrative. The CPU story did not emerge in a vacuum. It sat on top of a week in which the upstream supply chain sent its own unambiguous signals that this infrastructure build is genuine and accelerating, not slowing. ASML had already reported the prior week, raising its full year 2026 guidance to 36 to 40 billion euros, implying up to 22% growth over 2025. CEO of ASML attributed the guidance upgrade to customers accelerating their capacity buildouts in response to surging AI chip demand. What ASML is telling you is that TSMC, Samsung, and Intel are collectively ordering more lithography equipment faster than even bullish analysts projected. That is a direct signal that the fab investment cycle has legs well into 2027 and beyond. TSMC reinforced this message with numbers that were difficult to argue with. Quarter one revenue in US dollar terms was $35.9 billion, up 40.6% year over year, with gross margin hitting 66.2%. TSMC raised its revenue outlook for 2026 to above 30% growth in dollar terms. It also said capital spending should trend toward the upper end of its existing $56 billion forecast range. When the world's sole manufacturer of leading-edge AI chips says it is spending more and growing faster than it previously guided, that is the single most important confirmation our portfolio can receive. TSMC stock hit a fresh all-time high on Friday, and this time it was not just about earnings. Taiwan's financial regulator changed a long-standing rule that had previously prevented local investment funds from putting more than 10% of their money into any single stock. Under the new rule, that limit has been raised to 25% for large companies like TSMC. Since TSMC is by far the biggest company on the Taiwan Stock Exchange, it is the sole beneficiary of this change. In simple terms, Taiwanese funds can now legally own a lot more TSMC than they could before, and analysts estimate that could translate into several $billion of fresh domestic buying flowing into the stock. It is a regulatory tailwind that has nothing to do with the chip demand but adds a powerful and durable new source of capital support for the stock. Lam Research delivered its own earnings this week and posted a third consecutive record quarter. Revenue came in at $5.84 billion, up 24% year over year and up 9% sequentially, with Customer Support Business Group hitting its first ever $2 billion quarter. Guidance for the June quarter was $6.6 billion, with advanced packaging revenue projected to grow over 50%. Lam raised the total addressable market, the TAM, for wafer fab equipment in 2026 from $135 billion up to $140 billion, citing upward bias. Lam is our clearest window into the health of wafer fabrication investment, and the message was consistent. AI-driven fab spending isn't just steady, it is accelerating. AMAT, Applied Materials, which reports separately, is trading in sympathy with these signals and benefits from the same HBM and leading-edge logic investment wave. The third major theme this week was a significant development in how hyperscalers are structuring their custom silicon relationships, and it reshuffled the competitive dynamics among our notable stocks in a way worth watching carefully. Reports surfaced that Google is in advanced talks to co-develop two new AI chips with Marvell, a memory processing unit or MPU paired with Google's TPU accelerators and an inference-optimized next-generation TPU. This makes Marvell Google's third custom silicon partner alongside Broadcom and MediaTek. The market read this as both a win for Marvell, which surged 6% on Monday, and a mild negative for Broadcom, which fell roughly 2% on the same day. The nuance, however, is important. The Google-Broadcom partnership is alive and well, having just been extended through 2031 in an expanded deal announced earlier this month. What is happening is not displacement but diversification. Google, like every major hyperscaler, does not want to be dependent on a single chip design partner. For Broadcom, this is a complication but not an existential threat. For Marvell, this represents a dramatic acceleration of its custom ASIC ambitions. This comes on top of the $2 billion strategic investment from Nvidia announced on March 31st, which integrates Marvell's custom chips and networking silicon directly into Nvidia's NVLink Fusion ecosystem. The practical consequence is that Marvell has gone from a one customer concentrated story to a multi-hyperscaler platform in the span of a few weeks. Google, Nvidia, Microsoft, and Amazon are all now in its orbit. That is a fundamental de-risking of the business even as the growth story remains intact. Broadcom, for its part, is absorbing the near-term sentiment noise from the Marvell Google headline from a position of genuine strength. Its Q1 2026 AI revenue accelerated to $8.4 billion, a 106% year-over-year surge, driven by the core Google TPU franchise and a $21 billion order commitment from Anthropic. While Marvell is capturing niche inference wins, Broadcom's $73 billion of AI backlog and a Google partnership extended through 2031 confirm its grip on the high-end ASIC market. With Q2 AI revenue already guided to $10.7 billion, Broadcom remains the definitive read on the massive scale of bespoke AI infrastructure. Further downstream, the neocloud names continue to accumulate contract momentum. CoreWeave and Nebius together received $48 billion in AI infrastructure commitments from Meta in recent weeks. CoreWeave securing a total contract value of $35 billion and Nebius a $27 billion arrangement covering dedicated and flexible capacity. Bank of America raised its targets on both names this week, with CoreWeave going to $120 and Nebius to $175. Both stocks participated in Friday's broader sector rally. The key context here is what Meta's infrastructure commitments collectively reveal. A single company, that is Meta, is simultaneously committing to CoreWeave for Nvidia GPU compute, Nebius for, again, Nvidia GPU compute, and now Amazon Graviton for CPU compute. This is a hyperscaler hedging its silicon exposure across every available architecture while signaling that no single supply source can satisfy its needs. That is the definition of a supply-constrained market, and it is precisely the environment in which every stock in our watch can win without having to take share from others. Nvidia had no major company-specific news this week. It did not need any. Every data point that crossed the tape this week, Intel's CPU demand commentary, TSMC's guidance raise, ASML's capex acceleration signal, Meta's $48 billion infrastructure commitment, the Marvell Nvidia partnership embedding, reinforced the core thesis. Nvidia's stock moved modestly higher on Friday as the sector rallied on Intel's print, and management's guidance toward $1 trillion in revenue by end of 2027 remains the North Star against which all of this week's developments were directionally consistent. The near-term calendar is material. AMD reports on May 5th, and the Intel earnings have raised the bar for what a strong CPU print looks like, but also dramatically expanded what the market is willing to pay for that outcome. And Applied Materials' upcoming print in mid-May will complete the equipment picture that Lam and ASML have already framed this week. The broader conclusion from this week is straightforward. The AI infrastructure cycle is not plateauing, it is broadening. The GPU layer remains essential and constrained. The CPU layer is now also constrained and accelerating. Equipment and foundry suppliers are pulling forward. The compute landlords are absorbing demand that the hyperscalers cannot build fast enough to satisfy internally. Every position in this portfolio sits at a node where that demand has to flow through. This week did not change our thesis, it deepened it. One development this week that deserves attention beyond the chip headlines is the concurrent announcements from Meta and Microsoft on workforce restructuring. Taken together, what they signal about AI capital allocation priorities is as important as anything that happened in the earnings reports this week. Meta confirmed on Thursday that it plans to cut 10% of its workforce, roughly 8,000 employees, with layoffs beginning May 20, while also cancelling plans to fill 6,000 open roles it had intended to hire for. Meta's own internal memo was explicit about the rationale. We are doing this as part of our continued effort to run the company more efficiently and to allow us to offset the other investments we are making. Those other investments are not ambiguous. This is the same week Meta committed $48 billion to CoreWeave, Nebius, and now AWS Graviton. Microsoft took a different but directionally consistent path, offering eligible US employees a voluntary retirement package, a first in the company's 51-year history, with the program expected to reduce approximately 7% of its US workforce by end of June. The underlying logic is identical to Meta's: reduce labor costs and redirect that capital toward AI infrastructure build-out. Combined, the two announcements put over 20,000 roles at risk, and over 92,000 tech workers have been laid off so far in 2026 across the industry. From our portfolio, the uncomfortable truth in these numbers is actually a reinforcing signal. These companies are not cutting because business is slowing. They are cutting to fund acceleration. The trade being made in real time is human headcount for compute infrastructure, and the beneficiaries of that reallocation sit directly in our portfolio. Alphabet, Microsoft, Meta, and Amazon are expected to collectively spend nearly $700 billion this year on AI infrastructure, and a meaningful portion of the funding mechanism for that number is showing up in the layoff announcements this week. The capital does not disappear. It flows into silicon, data centers, and energy, which is precisely the supply chain our positions are exposed to. The broader societal implications of this shift are real and worth acknowledging, but from a portfolio construction standpoint, the message is unambiguous. AI capex is not a discretionary line item that gets trimmed when budgets tighten. It is the budget itself. I hope you found this week's analysis useful. If you did, please leave a comment below and hit the like button. It genuinely helps the channel grow. You might also want to consider joining the membership program, where I share more frequent updates on the portfolio of stocks we covered today. As a member, you also get access to the Stock Lens page, where I maintain a living portfolio tracking the key tailwinds, headwinds, and signals I am watching for each position. The link to join is in the comment section below. Thanks for watching and have a great rest of the week.